The concept of working capital, and what is working capital? See, working capital in an equation form, it is given, the explanation wise it is given. As the name, it suggests that it is a capital that is used in day-to-day activities. So to run the business, so there are requirements of capital so that the activity can be smoothly carried out. To meet that day-to-day activities or day-to-day operations, any amount of capital that is required is called as working capital. Okay, so there is a purpose why a business organization is established. See, we see that um, there is a main activity or main operation which has to be carried on so that revenue can be generated. See, the purpose is not to invest huge amount of investment without any activity. It is meaningless. Somebody invest 20 crores in a project and there is no revenue that is generated, no activity going on, then that entire investment is just a waste. In fact, even if the amount is very small also, if there is some activity that is going on, it will generate revenue. Slowly it also grows, and then they can increase in size, profitability, etc. So the operation has to be carried on every single day. Some amount of activity, main operation has to be carried on. But that operation, that activity, if it has to be carried on, it should be supported by some amount of capital that is required. Okay, so the capital available for conducting the day to day operations of the business is called as working capital. So some amount which is there with which they can run the business. In an equation form also it's given. Equation form, what is working capital? So working capital is equal to, we see that it's a difference between current assets and current liabilities. How do we define what are current assets? How do we define what are current liabilities? So that we need to now understand. All aspects of both current assets and current liabilities to be managed for what? Let's see. But then first let's understand. We should also understand what's the meaning of current assets and current liabilities. See, in a balance sheet, let's say a T form of balance sheet, if this is asset side and this is liability side, we see broadly classifying assets are classified into current assets and fixed assets. Broad classification. On the liability side, the classification of liabilities is into three categories. Of course, some of them write the classification on the asset side also as three types. One is current assets, second one is investment, third one is fixed asset. But then a common practice is that investment is clubbed together with fixed assets, and we generally see that it is only two types of assets. Here, liability side, we have current liabilities, we have long-term liabilities, and the third category is called as equity. So what are current assets, what are current liabilities? Let's first understand. Those assets that can be converted into cash, the assets that can be converted into cash in a period of 1 year or operating cycle, whichever is longer. What is operating cycle also I will explain you. 1 year or operating cycle, whichever is longer, those assets we call them as current assets. What are current liabilities? Those liabilities which have to be discharged, pay back, repay them, which have to be discharged in a period of 1 year or operating cycle, whichever is longer, we call them as current liabilities. Okay. So when the investment amount, the capital amount is raised and it is invested, partially it is invested into current assets, the other part of it is invested into fixed assets. Fixed assets like property, plant, equipment, and multiple other things, when they are invested, they are not they are not easy to be converted into cash. See, if plant and machinery is purchased, See, when they require cash amount, is it possible to sell off plant and machinery? It is not feasible. It doesn't work out for a business, because that is what is the infrastructure which they require. Only when the plant and equipment or machinery, these things are there, they can carry on with the production activity. So it would not get converted into cash. They do not have the intention to convert it into cash. Okay. So in that case, but cash is also required. Cash is required to run the business, like to meet the expenses, to pay when material is purchased, to the supplier payment has to be made, to run the business, like rent, salaries, expenses. These things all have to be met out of cash balance. So cash is required. Then again, we see that there is a contradicting view here. What we see is cash kept idle does not give any return. Let's say if you have 1,000 rupees, you put it in a box, open it after 1 year, 1,000 will be 1,000 only. That would not increase at all. So cash, if it is kept idle, it is not at all beneficial for the business. So cash only when it is invested into some asset, then they can earn a return. See, even if it is very very minimum also, if it is invested into an asset, it gives a return. So therefore cash is generally not kept idle. It is not available in the cash box. At least it will be there in bank, some minimum. No matter how small it is also, it can earn some interest amount. So the capital amount that is raised is invested into fixed assets which are invested for a long period of time, which are not easy to be converted into cash. One portion of it, another portion of it is invested into current assets, which get converted into cash. Let's say they have short term investments, so after a while, maybe after few months, they can sell it away and then get back the cash. If they are they have purchased inventory. If they have inventory after a while gets converted into finished goods, they can sell that, get some amount of cash. If they have already sold on credit basis, customers will pay after a short period of time. So something which can give them back in the form of cash. Cash is needed. Cash, if cash is there, with the cash they can meet all the other expenses. So cash is required. So that cash will be provided by current assets. Okay. So why is cash required? Cash is required to pay off the current liabilities. Current liabilities, the liabilities which have to be discharged in the short period of time. Short period of time. How short is the period? Is either 1 year or operating cycle, whichever is longer. But what is operating cycle also we'll discuss. So they have to pay back. Why did the liabilities arise? The short term liabilities, maybe some taxes due, some wages and salaries are due, rent is due, or the major current liabilities because material was purchased from the supplier. So to the supplier, amount has to be paid. For that they require cash. See, if they do not have cash, what happens? It's a problem for the business. See, if they do not have cash, payments will not be made promptly. If payments are not made promptly, it affects the reputation of the business. Now, everybody will look at the business as if they do not have funds available, they cannot run the business. So, in future, nobody will like to associate with the business. So, cash is required, cash has to be available, but cash just kept like that is not beneficial, therefore it is invested into current asset. So in short period of time it gets converted into cash, and that cash, when they have that available with them, they can discharge the current liabilities, meet the operating expenses. So working capital here is defined as that portion of current assets which is over and above the current liabilities. See, after discharging all the current liabilities, any more amount which is available will be used to meet their day-to-day requirement. Day-to-day requirement, like salaries are paid, rent is paid, they require some stationery, these things can be purchased, telephone bill, supply expenses, many things are the legal charges, audit charges, insurance has to be paid. So all these things cash is required. So that portion of cash which is available after discharging the current liabilities is working capital in an equation form. If they have working capital available with them, so what happens? All aspects of both current assets and current liabilities need to be managed, so that See, if it is in form of cash, no return. We already know that. In a box, cash box, you put any amount of cash also, it still will not give you return. Not 1 year, 2 years, 10 years, 100 years also, it still will be there as it is. It will not change. It will not give a return. So therefore, to earn a return, some investment that is made into assets only when it is invested into assets, return will be earned. So working capital will help us to maximize the return on assets, one aspect of it. The second aspect of it is very, very important is the chance of they becoming insolvent can be avoided. When do they get insolvent? When they do not have sufficient funds to make the payment, then they become bankrupt, they become insolvent. That is the situation. Insolvency arises when they do not have sufficient funds. Generally, see, even if there is too much of investment in the business also, whenever they do not have sufficient cash balances available with them, that has an impact on the business. The reputation gets affected. Other in future, other stakeholders do not get associated. Supplier refuses to supply the material. The other stakeholders like employees may leave the organization because salaries are not paid promptly. Many expenses become, see, in future banks refuse to give loans to them. Okay, everything becomes complicated there. So when the activity gets affected, there is a chance of bankruptcy or insolvency. So if they are able to manage working capital anyway will maximize the return on assets. Second one is it helps them from becoming insolvent, minimizes the risk of insolvency. For that reason, working capital and study of working capital is very, very important. There are strategies related to working capital also which have to be taken care of it. Okay, so now the definition wise, when I was talking about definition, I said um, current assets or current liability, there is a time period of 1 year, 1 year or operating cycle, whichever is longer. So what is this operating cycle? Let's first try to understand about what is the operating cycle as well. Operating cycle is a time period which requires, from the time this cash amount is invested into assets, the time period which requires for this cash which is invested to get back in the form of cash. How much time does it require from the time they invest cash until the time they get back that cash? So they invest this cash into what? Into their main activity. What is their main activity? Main activity, the operation of the business is buying and selling. What do they buy? They buy raw material. What do they sell? They sell finished goods. So the main activity is trading. So trading is, do they just buy and sell? No, they buy raw material, they get that converted into cash, and after they get converted into finished goods, they sell the finished goods and then get back the cash. So how long does it require? How much time does it require? Or what is the cycle that goes into that from the time cash is invested till the time they get back the cash? So first cash would be invested into purchase of raw material. Okay, raw material is purchased. This raw material gets converted into finished goods. Gets converted into finished goods, or production work starts. Production work. So once it starts, sometimes depending on the nature of the business, sometimes we see that the production work gets completed in a short period of time. Sometimes it takes a very long period of time. Heavy industries and all, operating cycle, the production work itself goes into more than 1 year also. Okay, it depends on the nature of business. So whichever business, so the raw material gets into production work. So till the time it becomes finished goods, it could be in the semi-finished form also. So raw material gets converted into work in process gets converted into finished goods. So finished goods are now available to be sold. So these finished goods are to be sold. If they sell it on cash basis, let's say the goods that are available on cash basis, if they sell, cash comes back to them on cash sale. On sale, cash will be received. But let's say if they have a strategy of selling these goods on credit basis. So they sell the goods on a day, but they say they give a facility to the customers that you pay after a while. See, after a while could be anything, 1 week, 10 days, 1 month, 2 months, 3 months. It depends from business to business. So some period is extended to them, so that at the end of that period, on once the period matures, then only the amount will be paid by the customers, or it will be collected from the customers on expiry of that credit period. Okay, so how long does it require for them? So now the cash is invested into raw material gets converted into work in process, into finished goods, and when these finished goods are sold on credit basis, we have accounts receivable. At the end of the credit period of this accounts receivable, cash comes back. Okay, so sometimes we see that material, when it is purchased, they do not purchase on cash basis. So little it gets extended. See, material is purchased on credit basis. They take some time. It's not that cash is coming immediately into material. They purchase material from the supplier on credit basis. So they take some time to make the payment. So until then, cash doesn't get into material. So they um, purchase the material on credit basis. At the end of the credit period, the amount is paid back to the supplier. So until then, we can extend this. It doesn't immediately get into raw material. So we are extending this period. At the end of that period only, cash goes into payment to the supplier. Okay, this is operating cycle. When we were defining what is current asset is a asset which gets converted into cash in a period of 1 year or operating cycle. This is the operating cycle. So how many days of operating cycle? Sometimes the days of operating cycle are few days only, 1 month, 2 months, 3 months. In some cases like heavy industries, the production work itself goes on for a very long period of time. So the operating cycle, it could be more than 1 year also. So 1 year or operating cycle, whichever is longer. So during this period, the investment that is made into current assets, when it gets converted into cash, we call them as current assets. Okay, we call those assets as current assets. Those that have to be paid back in 1 year or operating cycle, we call them as current liabilities. Is the meaning of working capital clear? Is the meaning of it clear? Please respond. How many? Only two are there. Kavish and Rehan Khan. What happened to the other two? This is a regular feature, or they just left it today only? Okay, you tell. Is it clear, the definition? Okay, let's move forward. So now in this context, what is cash operating cycle? So there's a formula for cash operating cycle. Cash operating cycle, the length of the cycle is equal to, in terms of the period. Okay, there is a formula given here. Please look into this one. The formula says inventory days. Please make a note of it. Inventory days plus receivable days minus payable days. What is the time period of cash operating cycle is? Inventory days, number of days inventory is held in the business. It is there in the inventory form, whether it is raw form, semi-finished form, or finished form. It is not sold. It is there in the inventory form. How many days inventory or stock is held by the business is inventory days, plus receivables days is after the goods are sold, how many days uh, of credit period is extended to the customers, that is receivables days. Inventory days plus receivable days minus, like they are extending a credit period to their customers, their suppliers also might have extended a credit period. So that is payables days. Okay. Inventory days plus receivables days minus payable days. Okay. The amount of cash required to fund the operating cycle will increase as the cycle gets longer. If the cycle is a longer period of time, okay, then if it takes a longer period of time for them to get back the cash, they will be held tight with the cash will not be available because it's taking a lot of time for them to get back the cash, to receive that in the form of cash. It is taking a lot of time. So if it is taking a lot of time, okay, to get the cash, then during that period of time their requirement for cash will increase. The amount of cash required to fund the operating cycle will increase as either the cycle gets longer, okay, or the level of activity of sales increases. When more sales happen, more is the activity, that is, lot of material has to be purchased, then it has to be get converted into finished goods. Finished goods are sold. Okay, so as the number of units that are sold increases, also more inventory has to be purchased, more activity has to happen. So then also we see that the working capital increases. These are the situations. Cash operating cycle reduce cycle time by, when can the cycle be reduced? The cycle time is when cash is invested into material, material gets converted to finished goods are sold on credit. At the end of the credit period, cash comes back. See, as long as that period extends, there is more requirement of working capital. But how can we reduce the cycle? Reduce the cycle is, don't keep the inventory for long period of time. As soon as the inventory is purchased, convert that into finished goods. Once it is converted into finished goods, then put in efforts to sell this finished goods and reduce the credit period. Okay, as quickly as possible they have to collect the cash from the customers. And on a similar note, because credit is extended by the supplier, they should avail the credit facility as much as possible, as long as possible. See, don't look into the ethical aspects of it. See, there's nothing right or wrong. Because the credit facility is extended by the supplier, avail that. Okay, avail that, and don't be in a hurry to repay back the supplier. Okay, extend or delay the payment as much as possible, but within the credit period only. It is not that day one only amount should be settled. Take it until day end and then pay the amount. So the cash operating cycle or the cycle time can be reduced when they quickly convert the raw material into finished goods. These finished goods are very quickly sold. Turnover is sale. When they very quickly sell these finished goods, so as quickly as possible this material has to be sold. Then we see that as early as possible amount has to be collected from the customers, and delay the payments as much as possible. In this context, there are few working capital ratios we have to learn, but technically speaking, as such, it is not the first time that you are learning, because you've learned MA, you have learned extensively ratio analysis. So very quickly we'll run through the what are the working capital ratios. So working capital ratios, it starts first with what is current ratio. You are aware of these things, I'm assuming that. Yes, Rehan, and then somebody else is there in the class, Kavish. Are you aware of these things? Okay. Current ratio is equal to current assets by current liabilities. See, out of the current assets, not all current assets can be converted, not all current assets can be converted into cash very quickly. Out of that also, there are two items which are not very easy to convert it into cash. One is inventory, because we already saw in the operating cycle that it takes a long time. This material, this inventory, it goes through a big process until it gets converted into cash. So it is not very quickly, easily converted into cash. So all current assets other than inventory, and one more item is there. Generally, it is not referred here, but any context, if you know that, you should remember that. Another item is called as prepaid expenses. Expenses that are paid in advance. See, it is almost like a difficult thing to get back the prepaid expenses. You can avail the benefit. So let's say if advance rent is paid, prepaid expenses, maybe for the future period you can avail, you can use that accommodation, or that facility can be used. But I mean, it is not a common thing that you get back that cash. You've already paid it, so you can get the benefit, but you cannot get back the cash. So on that context, other than inventory and prepaid expenses, all other assets are quick assets. Only these two assets are not quick assets, which can be easily converted into cash. So quick ratio is equal to quick assets divided by current liabilities. Normally here we see that only inventory is considered as a non-quick asset. Then individually we see that, individually we talk about what is see, under current assets we have receivables, we have inventory, we have short term investments, cash in the form of um, absolute cash which is there in cash box, or cash which is there in the bank, cash which is there in the securities which can be easily sold. So these are all current assets. Very specifically we need to find out we need to find out what is receivables collection period, what is payables payment. Under the current liability, this is payables, and one more thing called as inventory. See, the cash cycle talks about how many days inventory is held, how much time does it require for the customers to pay receivables date, how many days can be availed to pay back to the supplier. So we need to now know what are the receivables days, what are the inventory days, what are the payable days. Only when we know these things, we would be able to understand what is cash operating cycle that can be calculated. So receivables collection period has a formula. Receivables divided by daily sales, sales on a daily basis. On an average, what are sales on each day? Daily sales, average daily sales. Okay. So in a year, there are 360, or sometimes there are, I mean, it is assumed that it is 360, sometimes otherwise, normally it is 365. So it is an assumption made, that is also. So if the question very specifically says that a year has 360 days, you have to stick to 360 days only. Okay. So receivables into 365 by total sales. Okay. This is the formula that has to be used. Because we are not doing management accounting, the logic, the formula wise, what is turnover ratio? Turnover ratio is equal to turnover divided by the other variable. So turnover is sales, sales divided by receivables. Now, sales divided by receivables, it, that gives us receivables turnover. I'm only just explaining one aspect of it. If we are talking about receivables turnover ratio, turnover is always in the numerator. Logic I'm explaining to you. So we have the sales divided by the other variable is receivables. So we have the receivables in the denominator. So this is turnover ratio. Collection period, that is number of days that required to collect the amount. So we call this as collection period. Average collection period is equal to, in a year there are 365 days. Out of 365 days, how long is the amount held in receivables? So how long is the amount held in receivables is calculated by receivables turnover. So this is receivables turnover ratio. But what is receivables turnover ratio? The formula wise, this is basically 365 divided by the denominator has receivables turnover ratio is sales by receivables. This is the equation. Numerator has 365. 365, if this is written as a fraction, 365 by 1. You know that, no? School you have done. So fraction by fraction is the denominator of the denominator goes to the numerator, and this one goes to the denominator of the numerator. You know this logic, I guess. So 365 into receivables divided by 1 into sales. That's the formula. Same logic applies for payable period. Same logic applies for inventory turnover ratio as well. So 365 into inventory by cost of sales. So the term inventory is different for different situations. For receivables, it is credit sales. It is for payables, it is credit purchases or total purchases. So in case of inventory, cost of sales. So we take inventory into 365 by cost of sales. It's not sales, but it is cost of sales. Okay. So that's the logic behind these three number of days: receivables days, payables days, and the inventory days. So if we have these three things, we will be able to calculate the cash operating cycle in length or in number of days. The length of a cash operating cycle in number of days can be calculated as inventory days plus receivables days minus payables days. Okay. These formulae can be further split in manufacturing companies as first one is how many, see, inventory could be in raw form, could be in semi-finished form, could be in finished form. Okay. So when we very specifically split that and how many days it is held in raw form, how many days it is held in semi-finished form, that is working capital form, sorry, work in progress form. I'm really sorry, work in progress form, or and how many days it is held in finished form. So very specifically stock of raw material by raw material usage into 365. Work in process by cost of production into 365. If it is finished goods, stock of finished goods by cost of sales into 365. Overall inventory turnover ratio is cost of sales divided by average inventory held. That's the formula. Why are we studying about working capital? We are studying about working capital to understand what is the position of the business in the short run. In the short run, is it sound? Is it doing well? What is the requirement in the short run? Whether they have sufficient cash balance or not is the requirement in the short run. So if they have sufficient cash balance, they can meet the requirements. They can meet um, the payments to the suppliers. The current liabilities can be met. They can also meet their day-to-day expenses. Okay, so understand the liquidity position or understand the short term position. For that reason, we have to study what is working capital. Okay. So, understanding the working capital or the position in the short run, for that, we would now be specifically looking into each type of current asset. Each type of current asset, okay, managing inventory, then inventory related issues. Then we would be looking into receivables related issues. Okay, in that context, whatever is there, and payables and anything related
Excuse
to
me, ma'am.
yes, ma'am.
Actually, some of the students are having some issues, and actually, we have had a bit busy day ahead. But before this, so can we end the class for today now,
Okay,
if
dear.
possible?
Okay, yeah, yeah, yeah. See, if there is any issue, you let me know, so we can end it tomorrow 5:30. We'll meet and then we'll take it up.
Sure, ma'am. Thank you.
What's the issue? Some college related.
Ma'am, ma'am, actually, ma'am, two of the students